Wattenberg joins me now. He's a managing director at Goldman Sachs International. Thank you very much for joining us. No one was really surprised by this, and it seems a sense of déjà vu, but really looking ahead, we're going to be really looking at the commentary coming out from the Fed, aren't we, to see when we're going to see the peak of this interest rate hike.
You know, that's right. I mean, I think it's going to be more steady as she goes, which is what Todd had alluded to before. And I think, you know, 475 in terms of the rate hikes might not be the end of the cycle. We could see a 5% number if the Fed thinks that the inflation still needs to be controlled. I think the text of the comments are going to be very critical. Also, the handover when Greenspan leaves is also going to be important to see how the markets react, to see whether or not that the Fed is going to be as clear as they've always been in terms of fighting inflation.
And the Fed talks about a sort of a neutral interest rate where, you know, it neither hinders growth nor fires inflation. Where do you think neutral interest rates are?
Well, I mean, it's difficult to call because we have a situation whereby the hurricane effects combined with the oil effects and also the question on the housing market in the U.S. means that these dynamics may mean that the rate may go up higher than the market expects because the Fed will be reluctant to stop raising rates. So we might actually see higher rates than the market is currently predicting right now.
And how can they possibly assess the damage from the hurricanes? Because it's pretty localized, wasn't it? But it's also had an effect on consumer confidence. But at the same time, it's going to boost the economy a bit because there's going to be some rebuilding down in that part of the world.
You're exactly right. There's a combination of good factors and negative factors. And I think the ones that you're seeing is stronger GDP growth, but you're seeing weaker consumer sentiment. And so since we know that the consumer drives the U.S. economy, most people will be watching to see whether they hold back their spending with the increase in the oil price. So at this point, the data is, you know, sketchy at best, and so we have to continue to look forward, you know, to see when we get more clarity.
And in terms of energy prices, this is something they really have to look at because in terms of inflationary pressures, there's one small area of prices, really, energy prices, which are really spiking, but the rest of the prices are pretty steady, so it's quite hard to take one inflation figure.
Well, it is tough, and also, you know, there are other factors just besides the weather-related ones. There's China that's consuming a lot of raw commodities, and then also we're going to be heading into, you know, the winter heating season, and, you know, with the way that the natural situation has been in the U.S., you could get a very cold winter, which could cause energy levels to spike.
And in terms of the new Fed chairman coming into his role coming into effect really in February, if Alan Greenspan continues rate hikes until that point, won't Mr. Bernanke be forced, whatever the conditions, to have another rate hike just to see that it's continuing the policy of Greenspan?
I think you're right. I think, you know, there is going to be this, you know, reward for being, you know, stern and aggressive with rate hikes, and I think you'll probably see that. But, you know, he's very thoughtful, and he's going to want to put his own stamp on this Fed, and so I think he probably does continue to raise rates. But then the big thing will be towards the beginning of next year, after he's in and after he gets a rate hike under his belt. What do we do at that point in time?
Okay, thank you very much. Wattenberg of Goldman Sachs.